Hey friends, welcome to the Mortgage Minute. And what in the heck is going on with mortgage interest rates? If you've checked in recently, we have just hit the worst levels we've seen since January 2014. In the mid to high 4% ranges, depending on credit scores. And let's dive in and figure out what's going on. First, before we go into where we are today, I want to take a little bit of a longer perspective on the history of mortgage interest rates, because we've really gotten spoiled over the last 5 to 10 years. And if you look at this chart, this is the 30-year fixed mortgage interest rate average over the last 30 years, over 30 years. We're going back almost 40 years. And you can see that if you kind of took an average through that whole trend line, the 30-year average is still above 7.5% going back over that time horizon. So we're a long ways from average. We're a long ways from some of the crazy interest rates that we saw in the 80s. But this trend of downward interest rates seems like it might be starting to reverse. So this was a chart that Freddie Mac put out earlier this year. This was their estimate as to where interest rates would be by the end of 2018. Well, they said their estimate was 4.1 in quarter one of 2018. I'm sorry to say we're closer to 4.6% today. So the trend is accelerating. Interest rates are definitely starting to climb. Now, why is that? I want to show you a couple of charts here. The top chart, and I'm going to get a little nerdy here, so I'm sorry. I'll try and summarize it in layman's terms. But the top chart is the mortgage-backed security trading for the last 4 years. And you can see on the right-hand side of the screen, it's just this sharp drop. Now, these are the price of the mortgage-backed security bonds. Mortgage bonds have an inverse relationship. The price of the bond has an inverse relationship to rates. So as the price of the bond goes down, the corresponding interest rate that a client would receive goes up. Now, you can see the last time we hit these levels was January 2014. That's the last time we've hit this range. And it looks like this 30 years history or pattern of rates going down might finally have reversed course with rates going higher. Now, why? Why have rates changed? Well, let's look at this bottom section here. I want to show you this. It says month 2 of the QE unwind. So the Federal Reserve bought over $4 trillion worth of bonds. Treasury bonds and mortgage-backed securities. They have since quit buying mortgage-backed securities, which is the precursor for interest rates, and they have started to let those bonds that are maturing fall off. That means there's excess liquidity coming into the market. There's not enough demand to buy those bonds, and so in order to get enough demand, they're having to go to higher interest rates. The market is asking for higher interest rates before they will absorb that extra liquidity of bonds. So the Federal Reserve still has over $4 trillion in assets that they need to offload. If this trend continues, it looks like that is going to really trigger higher interest rates in the future. Hey, I'm going to leave it at that. I hope that you will take a minute and leave us some comments. I'm certain you might have some questions on how this works. I'd love to answer those, and I hope you have a wonderful weekend ahead. Thanks for tuning in today.